Good morning, folks. Be getting started in just a moment here. Welcome to this week's edition of Back to the Futures with me, Markets and Mayhem. I'm excited. Should be interesting. This is certainly a big week. We've got the Fed. We've got a slew of economic data, including labor market data, GDP, PCE. We also have the biggest week of earnings, about 33% of the S&P 500 reporting. So it's a little bit of everything for everyone. Of course, we also have the Treasury's QRA on Wednesday. So sort of one of the most important weeks of the summer happening, playing out right now. And I'm excited. I love seeing these things play out, digging into the details of what's just happened and how it may be moving markets and individual companies, sectors, as well as other parts of the market like commodities. And I think that this week will be pretty important for informing our view going deeper into the third quarter and really trying to get a sense as to how healthy is the AI narrative, for one. Where's that distribution of treasury issuance going to happen? Is it going to be loaded on the short end? Or are we still going to be continuing this liquidity driven party from fiscal dominance and conservative treasury issuance on the long end? And also, we're going to get a better sense from the Fed as to when they may be cutting. I don't think it's going to be this meeting. I think we'll likely see that first cut in September. We also have JOLTS this morning at 10 a.m. I think that's going to be pretty important just to get a sense as to what some of this labor market data may look like. The consensus is 7.55 million. A meaningful drop below that, let's say 7 million or less, will probably bring down long end rates and it may even spark a bid in equities. On the other side of that, JOLTS that is hotter than expected, let's say 8 million or more, would likely put some upward pressure on the long end, could put some downward pressure on equities, and also would likely change some of the views, at least modestly, of how much the Fed would be cutting. So that'll be the most interesting data point that we get today. JOLTS at 10 a.m. Eastern. Let's dive right in. First, as always, manage your risk first and foremost. That is how you survive as a trader or as an investor. Make sure you're managing your risk first, because anything that you buy, you may lose a good amount of that money or all of it, depending on what strategies you're employing, including things like options. So make sure you're cognizant of how you're managing that risk. And I say that because I don't want to see folks out there get hurt. And I do want everyone out there that can, who wants to put in the work to find their path towards success in trading, in investing, wherever your goals are to try to reach financial independence. A bit about me. I started trading in 2005. It's been an amazing journey for me, one of building wealth, but also, and more importantly in my mind, building knowledge. There is no limit to how much you can learn from financial markets, in the world of economics, and how it ties together into so many other parts of the world. And now, because tech is such a dominant theme in the markets over the last several years, and especially right now, it's a great time to learn more about tech. And I think that this opportunity that we're seeing ahead of us with AI is going to be a pretty disruptive force. Combine that with automation and robotics. It's a great time to learn more about how technology is going to impact various industries, sectors, countries. I think that the impact will be larger than anticipated, but also will take longer than anticipated to play out. The biggest thing that I wanted to share about my lessons in these markets over the last 2 decades is leaning more into a systematic approach. Discretionary trading can work if you're wired for it, but from what I've seen in my own experience and working with others, most have a higher probability of success taking a more data driven, systematic approach, leaning into following momentum, as an example. The folks at Bookmap would love for you to consider joining us on their Discord. I'm there every Tuesday, 9 a.m., doing this exact chat. I love it. It's always fun to do these educational streams, and there's others on there as well. So come on over, check it out. And if you'd like to pick up a copy of Bookmap for yourself, you can get up to 40% off your first billing cycle. Visit Traderade.com/bookmap and scroll down to the special offers. Now we're about to get right into Bookmap, but before we do, I wanted to share my daily pivots for today. And I'm just going to quickly make a screenshot of those as well so I can share them. The daily pivots are going to be ES 6434.50 and NQ 23578.25. And the reason I'm choosing those levels is these are levels that the market is giving us some indication that they are important. I'd love to see price rise above that 6434.25 level. We're just challenging it right now pre-market. I think if we can make a push above it, we open up that next pivot level, 6443.50, to be challenged. And breaking above that should give us some pretty good room higher. On the other hand, moving below the 6434.25 pivot and key 2 plus confluence area, there is some support down there. That is also where the most active SPX strike was trading yesterday. That could give us some continuation lower. And we'll look at those charts in just a moment here as we get into Bookmap. And so on screen, we can see we've got Bookmap here. I do want to quickly just show those pivots for the S&P as well. This is the daily pivot, that's 6434.25. We can see that is just above T2 plus, where yesterday's most actively traded call was, and where that's the third largest area of positive gamma or call gamma driven exposure on the S&P options chain. So this would be an area to watch for support. It is potentially a formidable area of support, but as we approach the market open in just about 11 and a half minutes, We do look at this pattern here as one of consolidation. The market is looking to decide its direction, and I think we'll get more clues. First, of course, in the first 20 minutes of trading as we form that opening range. But secondly, as we get that JOLTS data, which when there's an outlier print that's large enough of a difference versus the consensus, which right now is 7.55 million, that can drive some pretty interesting price action. Now, I want to give a quick primer on Bookmap because some folks are tuning in that are more new to this and not necessarily sure of what they're seeing on screen. So I'm going to get ready to do that here, but I'm also going to check in on the chats and see how folks are doing out there. And good morning to everyone watching. Hope everyone's got a happy Taco Tuesday ahead of them. We do, speaking of taco, as that has become a moniker for the president, but we do have some trade deals being discussed as well with the EU, with Japan, and otherwise. And the headlines often suggest that there's going to be these really large amounts of purchases or investments or otherwise, but of yet, we haven't really seen those themes playing out. So it'll be interesting to see how that takes shape in the weeks, months, and years ahead. So let's talk a little bit about the heat map on Bookmap. And we're going to zoom out to do this as well so we can see some of that pre-market activity. This is a longer term view going back to about 1 a.m. in the overnight. Overall, a pretty uneventful overnight session. You can see we've just been consolidating, similar to what the last chart that I showed you from Motive Wave looks like. And really, I think that the market is going to be more exciting during regular trading hours today than it was during Globex. I know that's strange to say because Globex has been where all the fun has been for some time. But it feels like there are some market events that will take place during regular trading, like JOLTS, that could set the tone for the day. Now, looking at the heat map, one thing that draws people's attention and I'm frequently asked questions about is what do these bubbles mean? Well, these are delta bubbles. So what they're showing you is volume and which party is the aggressor. The larger the bubble, the more aggression. So you can see most recently there's been some more aggressive sell side delta bubbles. When you see a fair number of these bubbles back to back, especially as we zoom in on smaller time frames, that can give you a sense that you might be coming up on a trend change because there's a big amount of order flow pushing things. And particularly if you're in an uptrend and you see a fair amount of these large red bubbles taking shape, that can be a sign that sellers are starting to get more aggressive. And you might want to look for downward continuation, potentially de-risking some of those longs. The other thing that you see on screen is the coloration of the area where there isn't price action. This is the heat map. And this color corresponds to where there's interest in price. This white line is showing you present time. And you can see it correlates quite well with the order book. These are the offers above price and the bids below price. So when you see red on the heat map, that's indicating that there's a larger amount of interest at those levels. Blue, black, those colors indicate less interest or none. The yellow line on screen, that is the point of control. And that is an area where most of the volume is transacted over the session. You can see that in the session volume profile, which is this SVP column. You can kind of consider that a history of where there was interest in particular prices throughout the session. Those levels are then marked based on the volume that was executed around those levels. So this point of control, you can see there was over 7,000 contracts sold around 64.22. That, as well as the selling just overhead, help to build this as the point of control level. So we could also see this if we do pull lower as a bit of a price magnet because folks have liked to transact around this level. And if we move on the heat map to the left of this white line, this is more of a historic look. That is to say, we're looking back as to where there was interest in price. On a similar note, these annotations on the top right and bottom right are showing you how much is on offer for the red 11,000 on top and on bid for the green 18,000 on bottom. And then conveniently, it calculates the delta, showing that at present, there's 6.8 thousand contracts in excess of what's on offer on bid, showing there's more interest in buying than selling at present. On the subchart here, we're tracking icebergs in light blue, stops in red, and the cumulative volume delta in green. It shifts to purple when it goes negative. Now, I don't see the cumulative volume delta as particularly useful in isolation, but I think it is helpful to contrast it versus stops and icebergs to show you if there's other parties that are participating that are going against the predominant flow, particularly with the icebergs. Now, some folks might ask, what is an iceberg? An iceberg is a specific order type that is meant to conceal the total size of your order. For example, if I wanted to move 10,000 lots of S&P contracts, I may only want to show 100 at a time, meaning I'd have to go through that order 100 times, that iceberg, until I fill that 10,000. Why would I do that? Well, if you look at the order book, there's no one showing that kind of size. If all of a sudden thousands of contracts appear on the order book on the bid or offer, that is going to potentially change how the market reacts. It tends to run away from those really big levels. So the motivation behind an iceberg, whether it's in futures, ETFs, or stocks, is to hide your size if you're in a situation where that size could impact price discovery negatively for how you want to execute your order. Icebergs imply some degree of patience. You don't need to get out right away. You're more interested in getting out at a certain price. This is an interesting bit of nuance. It's also important because this affects how we analyze basically the picture that is being painted on the screen. If, for example, let's say we have a rather nasty drawdown. S&P is down, for example, 1.5%. And then you start to see thousands of iceberg orders cumulatively coming in from some of these larger desks on the buy side, just as a lot of those longs are being stopped out in larger and larger size. So you would see this red line moving lower on the subchart. You'd see stops going more and more negative, and you'd see icebergs moving higher, going into the thousands in positivity. That kind of confluence can give you a sense that there's potentially a reversal. Certainly, at the very least, there are larger institutional players interested in making buys. So if I was short into that, I'd be taking some off and I'd be looking for signs of a reversal. And I'd love to match that confluence up with what we're seeing in the options flow. On the rightmost panel here, this is the SPX options visualizer. This is a data add-on that I've built for Bookmap and MotiveWave. And what this does is it analyzes the entire S&P options chain to find key levels of interest, and it also updates the flow minutely to show where there is volume coming in. And it focuses on the two most active call strikes and the two most active put strikes to illustrate where the most interest is in terms of volume. So we can see, for example, yesterday, the hot call level, 120,000 contracts traded hands there. The second most active call, or the warm call, 117,000 contracts traded hands there. But the hot put stood out with the 160,000 contracts trading hands there. We also saw S&P skew towards puts rise a bit. What that's telling you is the volatility premium for downside hedges and bets increased a bit yesterday, going into this week with so many event volatility catalysts. There is some hedging, even ahead of jolts. So we may have some reaction where some of those hedges are removed, particularly if jolts comes in lower than expected. And that could be market positive. So we'll be watching, but that is a basic overview of what you're seeing on screen. And if anyone has any questions, feel free to drop them in the chat. And Chris asks, when you get a chance, can you talk about the gamma levels over to the right and where you're pulling that data from? Sure, I talked a little bit about that. That is the SPX options visualizer. And pulling that data from my own tool. So you can learn more about it by visiting traderade.com/SPX. And the way that this tool works is it's analyzing the data throughout the trading session. So I know a lot of these tools just kind of look at it once, give you one set of data, and that's all you have throughout the day. This is refactoring those levels as well as the flow minutely during regular trading hours. So it's really unique in the sense that it's going to give you those updates as there's positioning changing throughout the day. So I've been asked, can I talk about a strategy of mine? Sure, I like to look at a confluence of the 20-minute opening range and options flow for a high confidence trend day strategy. So the first 20 minutes of trading, you're forming a range, high and low. And let's say we're looking for a bullish setup. We'd want to see a breakout above that high, acceptance built for at least 5 minutes of trading. And we'd also want to see flow agree, and that is to say the two most active call strikes in excess of the two most active put strikes by 40% or more in total volume. Between the 20-minute opening range breakout to the upside and call volume in excess of put volume on the two most active strikes by 40% or more, you're more likely to get pulled higher into that most active call and have something that more resembles a trend day. So that would be a very simple strategy that one could implement using Bookmap or any other charting tool that's able to pull in that options data that I'm able to provide. Right now it's Bookmap and MotiveWave. I'll be looking at other platforms soon. But for the S&P 500, that would be one trading strategy that you could implement. And then you could look at the options levels and the liquidity interest levels as areas of potential support and resistance. Ships asks, teacher, so many times I see a big red dot, I go short and the market reverses, or a big green dot, I go long and the market starts going down. Why does it seem to do the opposite of what I'm seeing on the screen? So I would say that it's really important to have multiple data points to key off of. I don't think that, at least for me and the way that I trade and I try to lean into the data, I can't just use a volume delta to make a trading decision. It could be part of the framework that I use to make a trading decision, but it's not going to be the whole framework. And the reason that I say that is because I want to see confluence. I'm a confluence trader. That's why I mentioned that opening range strategy supplemented with options flow. You've got two data points, they're pretty powerful, and working together, not in isolation, but working together, they can provide more insight as to what may be taking shape as a trend day. So I think that it really has to do with what you're seeing on screen, not necessarily being the whole picture. If you just see one big sell delta or one big buy delta, that doesn't necessarily mean you're going to see trend continuation. So I think it should be part of a more elaborate framework to get a sense. For me, I do market prep before the market opens to get a sense as to what levels I'm going to look at. Some of that is automated. I have the pivots that generate themselves on our Discord, as well as this options analysis. And some of it is more driven by looking at charts and getting a sense as to where some of the other areas I need to pay attention to exist, like these 21 EMA. That's an average I watch very closely on the 5-minute chart, the daily chart, and the weekly chart for trend health. On the 5-minute chart, it's called the big green line. This is a really easy trend health indicator you can add on your own chart. Just a 5-minute period, 21 EMA, and make the line green to honor its name. There's a lot of studies on this. In fact, one of our mods has a tool that he wrote that's a bot that trades off the BGL that's pretty neat as well over at Traderade. And both of our mods, Boog and Wags, wrote a whole white paper about trading off the BGL, which is super impressive just to see the amount of depth of research going into this. It seems like a simple strategy, but when you zoom in, there's a lot to it. And again, confluence, BGL break up, breaking above the BGL, building some acceptance above the BGL, and then seeing options flow agree can be a good way to get along. And Hump TV, I would just say that for the 20-minute opening range, that's one strategy to have in one's playbook. It's not necessarily the only strategy, but it is one that can help. It can help for a few reasons. One, the first, I would say 20, 30 minutes of trading are very heavy on the institutional side. And there's a lot of cross currents. There's some leftover trading that's finishing up from the prior session. And there's just a fair amount of cross currents of order flow that you don't necessarily want to just jump ahead of, especially if you're not a very experienced trader and you're not necessarily sure of how to gauge the direction where the market may be going. So I think it behooves us to sit on our hands a little bit to not get in the way of that, for one. Secondly, to see where there's interest in price and if there's a trend forming can be very helpful. There's different opening ranges. People go all the way from like 30-second opening ranges all the way to 30-minute opening ranges. You've got to find what works best for how you trade. Personally, I've liked the 20-minute opening range for when I'm looking for an opportunity to try to trade a trend day, which today may end up being. We have a lot of consolidation pre-market. It's kind of like a coiled spring. It usually resolves directionally. So I'm looking at that and saying it's more likely with this pre-market Globex that's so back and forth choppy that maybe we get a bigger directional resolution. So today, I'm definitely watching that 20-minute opening range and the options flow to get a better sense as to where the market may be going. And there's another bit of nuance you want to add. If you're using the 20-minute, 30-minute opening range, whatever the case may be, you're coming right up on JOLTS. JOLTS at 10 a.m. Eastern with a consensus of 7.55 million. Very important when we're having that kind of an event to step aside or at least not have a lot of size on if you're day trading, because liquidity in the order book is going to evaporate ahead of the event and during it until just after. And you can get some big moves and you may not get the kind of fills you want, whether it's on exiting to capture a reward or stopping out, which is a market order, which means you're at the mercy of wherever the market's trading and able to give you a fill. So I think it's also important when there's an event volatility catalyst like JOLTS on the order book or on the event calendar to be careful because of the impact that that's going to have on liquidity and price discovery. For me, I would typically like to see the number print, get a sense as to what it means, and if it's an outlier print, that's going to help to inform my decision to some degree as well. For example, if JOLTS comes in at 8 million or higher, I'm more likely to fade any pop that comes from hedges being removed. If JOLTS comes in at 7 million or lower, I'm going to be more likely to look for longs into that. But I want to watch just maybe a few minutes of price action as the liquidity comes back to get a sense as to what that range is going to be in the reaction to that event volatility catalyst. One thing you're going to notice about people that have been trading for a while is they're more going to take the sniper approach. It's not relentlessly scalping for the sake of being in the market. It's more finding the setups that fit one's criteria and taking them when they exist and not taking any trades when they don't. So, Ships, I think you mean Fed Chair Powell. I think that's what you're asking about. So, the Fed ostensibly looks at unemployment and inflation as measured by PCE. Those are the two key metrics that they tell us they inform their mandate from, which is maximum employment and price stability. We have heard Chair Powell discuss JOLTS before, but not necessarily with, I wouldn't say it's a key focal point. I would say it's a data point that they pay attention to, particularly when Powell is saying things like there's this many jobs on offer versus this many people seeking work. But I wouldn't necessarily say it's one of the biggest data points that the Fed looks at. It is a data point they're aware of. I think it factors into the calculus of their summary of economic projections. But I don't know that they're, going to look at JOLTS in isolation and make any decision just off of that data point. Now, I think what's important about JOLTS is it gives us a sense as to where there's offering, where there's jobs being open, where there's people leaving their jobs, where there's people being terminated from their jobs. It's a pretty rich set of data. And by the way, markets are open now, just opened up on the S&P 500. We did get a bounce off that key 2 level pre-market. You'll notice that. We talked about that pre-market, that could be an area of support to watch. And we are pushing above that initial pivot here, that 64.34.50. So far, positive reaction in the S&P 500. But I would say we're still trading in that range that we have been through Globex. So just something to keep an eye on here. We are pushing above the BGL as well. I'm looking at that on just a separate screen. And then, Ships, your second question, what is my business trading opinion of Powell? There's a lot to unpack there. I will say personally, I'm not a huge fan of the Federal Reserve as an institution. I really think it invokes too much central planning in how rates are set on the short end. And I think there should be more market involvement in that. But I will also say the Fed doesn't control rates, it just influences rates. But Powell, as a Fed chair, has done overall a reasonably decent job. Remember, prior to him, we had Yellen, Bernanke, Greenspan. I can't say I was much of a fan of any of them. I think Powell comes out ahead a bit in his ability to communicate. He's a little bit more clear, but he's made his share of mistakes. Remember, inflation is transitory. That obviously didn't turn out so well. And I think now he's on the other side of the ledger, wanting to be more conservative about cutting rates because he's concerned about his legacy, and he's got less than a year left at the job. So I'd say he's decent, but I'm just not really a fan of central banking as a whole. And Hump TV says, great info. Thank you so much. You're very welcome. Glad that's helpful to you. And Ship says he's one of the best teachers ever. Well, that's extremely kind. Thank you for saying that. And folks, if you have any questions in the chat, let me know. Can I talk about ES-NQ divergence and how that impacts your context about what is going to happen? I mean, this is more about where there's interest in the market. When you look at a heat map, you can kind of get a sense as to whether or not it's going to be tech that's leading or if it's going to be other parts of the S&P 500. I personally have really been enjoying messing around with FinViz for this because it just makes it really easy to get a sense as to where there's interest in the market. So, this is, let's see if I can pull this over a bit. This is a heat map for the S&P 500. And you can see just in today's trading, there's a bit more interest in tech than some of the other parts of the market. So that's likely to lead to some more strength in the NASDAQ. So, Strength in the NASDAQ largely has to do with where flows are going, which sectors and industries are being bid. Is it factors that are more growth oriented, more tech, more biotech, things like that? Then the NASDAQ's going to lead. If it's going to be a rotation into some of the older economy stocks, industrials, energy, utilities, financials, things like that, it's going to be the S&P that leads. In terms of how that informs my decisions, I mean, really, it's more about which instrument do you want to trade. If you have a day where tech is clearly leading the market, it's probably going to be a better day to trade NQ or triple Q versus a day where there's the more traditional older economy stocks. Would probably be a more exciting day to trade the S&P 500. The other thing you can always look at is flow in the options, things like SPX flow, where that's telling you there's interest in the highs and lows of price versus the top call and top put. And you can also look at that in triple Q and NDX to get a sense as to where that interest exists and which strikes are the most active, whether they're the calls or the puts, to get a better sense as to where there's interest in taking the market, particularly that day. But in terms of looking at one or the other, what you're really talking about is relative strength versus relative weakness. And you can actually qualify swing trades off of that. If you see one part of the market showing relative strength consistently and another part showing relative weakness consistently, that can also set up pair trades. For example, there were some fantastic pair trades of being long NASDAQ, short Russell, which is the hedge fund favorite. And it works until it doesn't, but it can be a pretty good trade when that relative strength versus relative weakness exists. But I think the biggest way to qualify where those rotations are happening on a sector to sector, industry to industry basis is just pulling up a heat map. And today it looks like, at least so far, the NASDAQ should get a pretty chunky bid versus the S&P. Had a pretty big outside candle for that first 5 minutes. Let me see if I can bring that up for you folks here. There we go. So you see that blue candle. This is a pretty big outside candle for that first 5 minutes of trading. This is, again, why I recommend some degree of caution trading the open. It typically is going to be pretty volatile. It does look like there's more interest in higher prices so far. I'm still waiting for the options flow to start coming in. But overall, that's what I'm seeing. We also see some pretty interesting squeezes developing today. We'll take a quick look at those in just a moment. And the reason I've been talking about squeezes, you might note, I usually talk more about futures and commodities and some of the index level ETFs. I've been talking about squeezes lately because they've been some of the most prolific trades, pretty chunky returns in short periods of time. And this has everything to do with hedge funds being caught and really having to cover in size. There's a lot of these things that have been moving against them, and the only thing they can really do is cover these, and they're running over each other as they try to cover. And you also have folks like us, retail, us home gamers, are pushing these things higher, using call options, buying shares, etc. So it's kind of the perfect storm. And, hate to say it, or maybe I don't at all hate to say it, but a lot of hedge funds are getting caught on the wrong side of this. Because coming into May, all the way through the present, they've maintained historically high levels of gross leverage. That's their entire book. It's the shorts and the longs. And they've also maintained pretty low levels of net leverage, which means that what's making up most of their gross leverage are their shorts. And a lot of these are concentrated bets and what I like to call hedge fund hotels. These are stocks, whether they're longs or shorts, hedge funds, hotels, are stocks that are dominated by hedge funds. A lot of the stocks that they choose to bet against, there's reasons for it that make sense. These are companies that are often struggling. They often have declining fundamentals. Usually momentum isn't on their side. But episodically, you have these periods of short squeezes. And these short squeezes sometimes can be extraordinarily rewarding, but you have to be very nimble to play them. So that's why I've been watching them, because we're back in the season. It's like I said, and I was on Benzinga the other day, and they were saying we should make a T-shirt. "'Tis the season to be squeezing." I mean, it sounds catchy enough. It's very niche, but that's where we are. We're in a period of time where these can run because there's still a lot of ultra concentrated shorts that likely need to be covered as hedge funds reduce their gross leverage, or what we call degrossing, and probably to some degree also increase their long side exposure. They still have a fair amount of buying to do. A lot of these guys puked up so many of their holdings in April and are still buying back as the market hits all-time highs. They've been caught on the wrong side of both sides of this. Retail has actually done extraordinarily well this year versus a lot of the institutional trading that happens at hedge funds and these systematic funds and otherwise. So we could see just so far that we do have that interest in higher prices. We just had a pretty big delta buy candle. Let's look at what that looks like in Bookmap here. So you can see that there is just a fair amount of interest in upside coming in. We're waiting for some of those options flows to come through from SPX. You have a little bit of selling on the iceberg side, negative 110. Nothing too significant here, but you also aren't really seeing too much conviction of yet from either side. The open, we saw on the downside a pretty aggressive sell bubble, then a little bit of iceberging, but now it's just kind of consolidating here without too much conviction. So remember, that trade we had overnight was pretty range bound. The top pivot I'd love to see us break above to get us out of that range bound trade would be 64.4350. But as long as we're over that lower pivot, I'm still looking at the price action with an eye on more upside to come. And we can also see some of that interest building higher in these offers. And again, the bid to ask delta, if we look at this across the order book, there's 7.5 thousand more on the bid than on the offer. I'm asked, do you think we will see a bigger crash after hitting around 24 to 25,000 on the NASDAQ? I will say first, I don't think that anyone can accurately and consistently predict black swan events, and a crash. A crash is a serious de-risking episode. It's a disorderly downside. So I would say that we are a bit extended. And as we get into especially mid-August through mid-October, seasonality deteriorates. September has a pretty sizable chance of downside in the NASDAQ over the last 5 years. So I'd say we have a higher risk of a correction, especially depending on how earnings go. And as we get further into the summer and seasonality deteriorates, a crash, I'm real hesitant to throw that word around. As you'll note, you don't see me using it much on social or otherwise because these are outlier events. Crashes are things that happen that most people aren't able to see in advance, and that's why you have a crash, right? Because a lot of people get caught off sides on some volatility catalyst. Like last year, around this time, a little later on in August, it was that the Bank of Japan hiked interest rates. It caused this cascade of de-risking, and there was a volatility episode that played out as a result of that. And then more recently this year, you had Liberation Day or hour or minute, whatever it was turned around very quickly. But when people were concerned about that, that also caused a volatility episode and a bit of I guess you could call it a crash. It was certainly some disorderly de-risking. But in terms of looking ahead and saying, well, does a certain level imply that we're going to have that happen again? I can't look at the market that way. I The more you hit new highs, the more likely you are to hit new highs. All-time highs tend to beget more all-time highs. So if we're getting to 24,000, 25,000, that's constructive, that's bullish. Things may be a bit extended here, especially if we're looking at things from the lens of valuation. But on the other side of it, there's not some obvious looming catalyst on the horizon to cause that disorderly de-risking. So I think the bigger risk that we have in the present is that we're on pause of buybacks, right? That's a big source of liquidity that comes into the market. We're in peak earnings season. We've got reports from some pretty big companies this week, like Microsoft, Apple, Amazon. And I think that that's going to set expectations. We also have the Fed. We have quarterly refunding. We've got a lot of other stuff that's happening underneath the surface economically with labor market data, GDP, and PCE. So you've got a lot of event volatility catalysts. But is it going to lead to a crash? I don't think so. I mean, personally, I think it's more likely that we're going to have these volatility episodes with greater frequency. But in terms of crashes, I'm pretty hesitant with the C word. Those are things that happen seldom, and most people aren't able to see them coming, which is a good reason to be mindful of how we manage our risk. Never have more exposure on than you're able to sleep at night with. If you're having trouble sleeping because you're thinking about what's the market doing, what's it going to do tomorrow, etc., probably time to reduce concentration or reduce leverage or both. On the other side of it, if you're growing more concerned that there's going to be a correction, that might not be a bad opportunity to raise some profit or put some hedges on or both. But at the end of the day, trying to see those things happening in advance, it's just not something anyone can really do consistently. And looks like we're set to retest that pivot we talked about a little bit earlier here. So I am watching that closely, and we are just shy of 14 minutes away from Jolt's data dropping. And if we're looking at this, so far we've got about a 16-minute opening range, pretty ho-hum, about 7 handles on the S&P. So we're watching that 64, 34.50 level that we're testing now, and right below it, that key 2 plus area. That's a confluence area that should provide some support, but if we break it, we've got room for downside continuation here. So as we watch for that to resolve, I'm going to bring up just a few squeezes that I'm watching on the radar here. One is ULCC, it's a Frontier Group. Another one is PII, Polaris. And the last one is Getty Images. I believe this was a SPAC at one point. So we'll look at these. We'll let these charts settle in a little bit. But these are coming up on my squeeze radar right now, so I'm just interested in seeing what's going on. Getty has been absolutely beaten down. This thing's trading at 196. That's pretty gross. PII, this thing's up 18.64% with interest and higher prices. You see 2,000 on offer at that 60. And then it's another 2,600 on offer at 70. Oh, and we've got a nasty print in ES. We're going to quickly switch back here because we just cut right through that lower pivot and key 2 level. We see a stop run playing out. 152 contracts stopped out. So this could be setting us up for some opportunities to fade. But remember, we've got jolts coming up. So I really do want to see how that resolves, because that could add some more volatility into a tape that's already showing us an interest in expanding its price range here. We're just getting closer to that 20-minute opening range, and we've got about a 9 handle range. Nothing too significant, but we can see that there's more aggression coming into the downside here so far. This is the most aggressive sell bubble we've seen since market open. And we do have some of that options flow coming in from SPX with much more interest in the calls than puts so far, about 2-1, with the hot call and warm call just overhead versus the warm put and hot put. We also have a put wall just below us, which may offer some support, but we can see this market continuing to cut lower here. Not seeing any headlines yet that would explain some of the price action we're seeing. And switching back to the squeeze radar, PII getting closer to that $60 target with some aggressive buying on the way. Let's check out NASDAQ. NASDAQ had a pretty solid open and is reversing that and then some, cutting to new lows here in regular trading hours. And seeing some pretty significant stop. I mean, a 427 stop run in NQ is pretty significant given the order book depth is only 8.7 thousand on this thing. So there are a lot of folks getting pushed out of their trades on this, and we are indeed moving lower. It looks like the most active put strike on the S&P 500 is our next downside target here. And a pretty healthy stop run in the S&P, but you're starting to see something we talked about earlier. The juxtaposition of a stop run and iceberg accumulation. Not quite enough yet to get my attention. I'd like to see more consumption on the iceberg side, but still interesting and certainly giving sellers just a little bit of pause here so far. So again, this is a stop run where longs are getting pushed out and forced to sell at market. And as that's happening, you've got some larger desks passively consuming 500 contracts. Got just about 8 minutes left until jolts. The consensus is for 7.55 million jobs on offer. And again, folks, be careful with size ahead of these event volatility catalysts, because if you do have an outlier print, price can move a lot and you may not get the fills you expect due to the order book being more thin. Another thing you'll notice on S&P is the delta between offers and bids has shrunk a little bit to 5.4 thousand. Order book depth right now about 31,000. Do I have a hedging strategy I use for my portfolio? I have a fair number, actually, that I employ. One of my favorites is long SPHD, short SPHB, and that's going long high dividend stocks and short high beta stocks as a pair trade. And typically that has similar performance as the VIX, but without the volatility of trading its futures and without the decay of trading its options. So there's one to consider. And PII really getting close to that $60 mark here. Starting to see the order book get a little heavier on that one. Could be halted really at any moment if it isn't already. But the way this thing is trading, it's already up 21% here. ULCC, this thing is just consolidating since the open, but I have a feeling that might get a further bid as the day goes on. Let's get back to the S&P 500. This is a little bit more of an exciting trading day than maybe we would have expected. And we could see the 20-minute opening range actually increase to about 14 and a half handles. That's not too bad. And I've just got to very quickly change the setting here. Bear with me. Let's take a look at those options flows real quick too. We still have more interest in calls. You could see the top two call strikes clocking in about 9,000 volume so far versus the top two put strikes at 6,000. So interest in higher prices remains the theme as we approach JOLTS. Also worth noting, S&P trading around 6,400. That is a pretty big level in terms of call positioning. Let me see if I can bring up that chart. All right, here we go. So you can see on screen SPX 6400. That is the second largest level of call exposure on the options chain. This is part of the SPX options visualizer that we have on our Traderade Discord, where you're able to see this gamma exposure on just about everything that's optionable. And we're focusing here on the SPX because this is the big daddy of the options complex, trading about 1.25 trillion in notional every day, more than all of the equity futures index contracts combined. And 6,400, if we do slip below it, it starts to become a bit of a ceiling, a bit of a resistance level. So important to watch as we approach JOLTS here. Just about 3 minutes away from JOLTS here. Order book's probably going to start lightening up considerably. That kind of feels like a headline just came through the way it's trading. Let's see if there's anything there. But that was a pretty chunky buy side volume spike that just came through. So GH asks, how many touches do I wait for in the break and retest strategy? I'd need to see a break above and some acceptance built at least a 5-minute time interval. So if I'm doing an opening range breakout, I want to see acceptance built above the range or below the range for at least 5 minutes, and options flow from SPX if I'm trading ES, or triple Q or NDX if I'm trading NQ, to agree with the directionality. So for today, for example, we'd want to see a build above 6440 with 5 minutes of acceptance up there, And we already have calls outpacing puts by nearly 2 to 1 on the two most active strikes. So that would inform me that we could have some upside continuation to that most active call strike or the hot call. Let me know if that is helpful for your question. And there's that lack of liquidity. You can see the order book is everything near price is pretty much gone, and the depth is down by about 5,000 to 6,000. That's really important to contextualize if you're trying to trade this thing. Your price discovery is going to be less ideal 30 seconds away from jolts. Now remember, the consensus is 7.55 million, a deviation of 8 or more million. That would likely lead us to long end rates higher, Fed cut expectations lower, and markets lower. 7 million or lower would probably give us a bid on the long end, probably help markets, and maybe even give us a little more confidence of Fed cuts in September and December. Print is imminent now. And we have pretty inline print. JOLTS coming in at 7.437 million. We also got consumer confidence this morning coming in at 97.2 versus a forecast of 96 and a prior reading of 93. So JOLTS slowing modestly. The prior month reading 7.769 million. The current reading 7.437 million versus a forecast of 7.5 million. Largely in line for both of these prints. So not a lot for the market to key off of. And looking at the way it's trading here, it looks like it wants to move higher based on the flow. I would want to see some acceptance built above the top of this opening range at 64.40 to give us a sign that we could have some continuation from here to the upside. And that wraps it for this week's edition of Back to the Futures with me, Markets and Mayhem. If you'd like to learn more about my work, visit Traderade.com. If you'd like to learn about the SPX options visualizer that you can see here, that's an add-on I built for Bookmap. You can check it out at Traderade.com/SPX. And finally, if you'd like to get 40% off of Bookmap for your first billing term, visit Traderade.com/Bookmap. That's Traderade.com/Bookmap. And folks, I'll be back next week, Tuesday, 9 a.m. Eastern. Hope you have an awesome week ahead. Look out for my coverage of the Fed tomorrow and of the major earnings. So stay tuned. There'll be a lot of other cool stuff coming in real soon. Have a great week, folks. Catch you soon.